Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio. "26 years of CNBC TV 18.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Nigel. Guys, good morning.
Morning.
Hi, good morning. So we got the much anticipated Fed rate cut. So that trigger is out of the way. So now as we unwind towards the end of the year, what next, right? What are we looking forward to?
More rate cuts.
No, this year. I'm talking about calendar year 2025.
Winding it down. Winding it down,
right? There's nothing. Is there any trigger on the horizon, a large one?
Christmas. But it's not feeling like that, right? In our markets, on a day-to-day basis, coming in there, a bit of a bashing is what most investors are getting. But a bit of a challenging time. Hopefully it passes.
Yeah, and maybe some stability, right?
Yeah.
But let's see. But it's getting tougher. And pain continues, as we've sort of been highlighting for the last 10, 15 days. And, in phases like this, and we've had this discussion with guests as well, it's better to sidestep and there are lots of attractive opportunities, and, our guests come on and talk about that. But it's about when you buy. I mean, you want to buy when, there's a broad fall and stocks fall for no specific reason of their own. Or you want to buy in a more cleaner kind of environment? That's the question. But, near terms are tough to call. Let's start from the top, right? So market pain continues. Mid-cap, small caps, of course, has been there for a while, but even large caps. Look at what happened yesterday. And, 13, 14, 15 days to go. Trading sessions to go for the end of the year. FOMC cut rates by 25 basis points, but it's a divided FOMC. And I just put that out. There is 9-3 vote. Only because in 2026, May onwards, it's going to be called Trump's Fed. But Trump's Fed does not mean that President Trump will get what he wants. As you can see, there were some dissents. There were two dissents, actually, in favor of a hold. And there was one guy, of course, Stephen Moran, who said, well, it should not be 25, but 50 basis point cut. So, it's a committee which decides in that sense. On their own, though, I would say, the Fed Chair Powell sounded, the expectation was what? That it's going to be a hawkish cut. That the Fed will cut and is done after that, and no more cuts, at least for the next couple of meetings. But if anything at the margin, this was not as hawkish. The cut was not as hawkish because, what did he say? He said two things. He said inflation, if you exclude the impact of tariffs, is close to target, right? That is one. And labor market is gradually cooling. Actually, towards the end, he kind of put out some numbers for the labor market data, which suggests that actually monthly job addition is negative. Inflation near target and labor market starting to weaken a little bit, that's not hawkish, right? That does kind of, it's up to, of course, how they read the data going from here, and that's what they said, but that's where, Chair Powell left it at. Now, there was one just surprising bit, $40 billion worth of Treasury bill purchases, which will start immediately. The quantum is also larger than expected. The frontier, especially the front end, the 2-year, 5-year, etc., saw some move. Even the 10-year yield lost about 4 basis points, and we were at about 4.15%. The S&P was up about 0.6%. By the end of it, Nasdaq up a little bit, but lesser than the S&P. Dollar index came off sharply, and 0.6% cut as far as the US dollar index is concerned. So, again, nothing dramatic post the Fed decision, but equity markets higher, yields lower, and the dollar index lower as well. I guess we could live with that. Just one name, which has, of course, which has become, it's kind of raised ahead from behind. Oracle, it was down 6.5% after hours trading. It posted disappointing cloud revenues. So more on this later, but the AI story is the big one. So Oracle, of course, is now also right in the middle of all of it. Oil prices 1% higher, 62.5 odd. Trump essentially said that the U.S. has seized, and there's some videos going around on social media that U.S. has seized a large sanctioned oil tanker off the coast of Venezuela. Venezuela is a very, very large oil producer, and there's been military build-up, U.S. military build-up around Venezuela, talk of regime change and whatnot. So we'll see if this is going to be another flashpoint, really. Just to tie in the levels here, not very much with regards to change. I mean, the numbers change because the moving averages change. The Nifty 20-day is at about 26,022. We, of course, are under it. And downside level, not really supports in that sense. But, I mean, it's about 1.5% away. Given the state of markets, you've got to keep that as a possibility. 25,320 is the November low. So keep that at the back of your mind. Bank Nifty 20-day moving average is 59,181. And we, of course, managed to close around it, close above it. Support stands at 58,600 or so as far as the Nifty Bank is concerned. All again within 1.5% of where we left off yesterday. Just the implied open with regards to GIFT Nifty indicating a strongish start. 90 points higher. I mean, the trick is going to be to start strong and then stay strong through the course of the day. Nigel is standing by. He's walked across with what the F&O positioning is looking like. Nigel, over to you.
Well, that's right, Prashant. By the end of today, we can end with some green or even the kind of opening that we'll like to see going by what the GIFT Nifty suggests. Well, the bulls will be very, very happy. But in yesterday's trading session, well, the sentiment was really sour and the broader market pain did continue. Looking at institutional data, though, the institutions were net biased because the DI buying is outweighing the FI selling. And the FIs, yes, they're selling, but they're selling 1,500, 2,000 crores or thereabouts. That can be absorbed. The problem is when that number goes up to 3,000, 4,000 crores or thereabouts. So they're sellers, but maybe not as large as what we saw 2 or 3 months ago. So that's one data point. The other problem is the broader market pain. That continues. And even in yesterday's trading session, you'll see the Nifty ended lower, but the mid and small cap indices, they took a sharper cut. And the problem is the margin trading book, that's trading at record highs, which means this money is borrowed funds and you're making losses on those borrowed funds. We'll have to see some kind of cool off on this margin trading book. Remember, in March itself, it was at around 65,000 and that's ballooned up to around 1.12 lakh crore or thereabouts. So some kind of cool off on this front is warranted. Till that happens, you could continue to see shocks in the broader market and some kind of pain, particularly in smaller cap stocks. Well, moving to the FI's futures data then. They added shorts both on stock as well as on index futures, as this plate is telling you on the screen. And in fact, on index futures, well, the short positioning that started around 85,000 contracts, well, that's ballooned up to around 1.5 lakh contracts, which essentially means in the month of December, the FI net short positions have gone up in absolute terms by close to around 70% at around 1.48 lakh contracts, and in percentage terms at around 89%. So this market is net short. It needs to stop falling for you to hope to get a short covering bounce. For the time being, these shorts are getting piled in the system because the FIs believe there's no deal in sight and sentiment is really sour as well. So they need to get trapped on the wrong side. What do they do in index options? Well, they went ahead, they wrote 2 calls for every 1 put. And because of this intense call writing, the PCR has come down to around 0.73, which is the lower end of the range. But what's giving you some kind of hope is, there is some put writing as well that is there. And the call writers there have been having a gala time. But since the 25,750 put did see some writing, and the premiums around 100 rupees approximately, the bulls will hope that that 25,650 level does get, protected on the downside. That support has been gradually moving down, but this 25,650 is an extremely important mark on the downside. Resistance, well, the 26,000 mark, 26,020 odd, that's where you have the 20 DMA as well. The Nifty Bank, well, that showed some weakness, but that needs to get back above the 20 DMA, which is going to be very, very important. That number comes up for you on the screen. I'll be looking at the tech index for a couple of factors. TCS has gone ahead, acquired a technology consulting firm for around $700 million. So that could be one stock in focus. And besides that, Oracle overnight, the revenues were a miss, negative cash flows, and the street is getting skittish on the big AI infra capex as well. So maybe that AI trade is gradually fizzling out globally, which may not be such bad news for tech out here. So I'll keep an eye out on the Nifty IT index as well, which has outperformed in the last couple of months.
Thank you very much for that. Just 3 thoughts on Oracle. Down 11.5% in post-market hours. So the disappointment was on the revenue front. It fell short on revenues. AI deals are piling up.
Yes.
The company's revenue, performance obligation, basically which gives you revenue visibility for the future, went up sharply quarter on quarter and is at more than $500 billion. So why is the revenue falling short? It's basically the fear is monetization is lagging. Secondly, the company also raised the capex guidance. In Q1, they said it will be $35 billion. Now they're saying it will be $50 billion. Now, increasingly, companies, including Oracle, are resorting to debt to finance their capex. Earlier, tech companies were cash rich. They had pristine balance sheets. So they never tapped the debt market. But now, Oracle, Meta are increasingly funding their capex via debt. And third, just the hypersensitivity of these stocks. Just 3 months back, when Oracle came out with those blowout quarters, stock had surged, skyrocketed 35, 36%. The market cap almost touched that $1 trillion mark, and everyone was asking, should Oracle get a seat at the table now with the Max 7? And then, one disappointing quarter, and the stock is down 12%. But that's Oracle. Let's quickly move on to the other big story. That's Fed. We got the 25 basis points rate cut. Listen in to what the Fed Chair Jerome Powell had to say.
The adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September, and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves. So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both. And I think we're doing the best we can for people.
We got the third successive rate cut by the Fed and the final one for 2025.